All right, welcome everyone. Sorry for the delay there, little technical difficulties, but thank you for tuning in. We got the comments up there, so feel free to drop a comment there in the chat. But good morning to everybody who is already dropping comments. As you can see today, we're going to do some of the basics, which is conventional loans. So we'll do a little getting back to the basics here. All right, people dropped in there in the chat. Good morning. Good morning. Just waiting a couple seconds here to get live on all the different platforms. Good morning. All right, well, we won't wait too long here today. Let's go ahead and get it rolling here. All right, so welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by our president Nick Hiersche and our sales manager Jose Gonzalez. We are a correspondent lender that does things a little different, and one of the things that we do is we go through the rates every single day, very transparent. We run through our rates every morning so we can see how the market fluctuates, and you can see the real rates in real time. We also do a deep dive into a different subject each day. Yesterday, we did our DSCR loan, which is our flagship product. And today, we're going to go back to the basics and talk about conventional loans. And Jose has some quotes pulled up as well to quote some real life scenarios with some conventional loans and talk about those as well. But before we do that, like we do every morning, we'll go ahead and have Nick pull up the current rates for a few different programs so we can see how the rates have changed for today. So that being said, Nick, go ahead and pull up the pricer and let's get into the daily rates for today.
All right, let me switch my screen here. And we'll pull up our pricing tool. This is a tool for our mortgage professionals. If you'd like a full loan estimate, please get with our team. We have over 350 loan officers in every state of the US and are licensed in 22 states for primary homes. And we can do our DSCR business purpose in pretty much every state. So this is a tool just for our professionals. It's going to show us the pricing indications for today, March 14th, just after 11 a.m. So we have all of our rates live. So we're going to set up our basic scenario as we do every day. Our 80% loan to value, 20% down payment, 99 price means one discount point in cost. We're going to find the best rate. We're going to compare conforming to FHA and then our non-QM programs. We do not do VA since only eligible veterans qualify for VA. So if you do, please let us know. We'll quote you. And for USDA, that's only for properties in a rural USDA eligible area, so not for everybody. So we'll start with our conforming conventional, purchase, 30-year fixed, standard loan, primary, single family, 1 unit, Florida, Miami-Dade, that's where our office is. For all of our estimates today, we'll use 760 FICO, and for all of our estimates today, we will use a 40 DTI. So let's check out our rates for this morning. So it looks like rates have gone up since yesterday. We saw a lot of activity yesterday, but now we're at 6.625 for one discount point in cost as the best combination. And remember to always compare your APRs at 6.801 here, so you can compare apples to apples. So if for any reason a customer doesn't qualify for conforming, we typically go to FHA as the next example. So we'll pull up here quickly our FHA rates to compare. We'll keep everything else the exact same. And let's check out our FHA rates. So FHA is a little bit lower in the rate, but there is yearly mortgage insurance and upfront mortgage insurance. The yearly's paid monthly. Those were reduced recently, so we have seen some reductions in the APR costs on these. But it looks like the best combo, 6% rate, one discount point in cost for an APR of 6.602. So you see FHA maybe a little cheaper than conventional in this scenario. but always a great option. Now, if for some reason a borrower can't qualify with conforming or conventional, most banks and lenders do not have any other programs available. But thankfully, at the Mortgage Calculator, we have over 4,500 other loan programs under expanded guidelines, aka non-QM. That's where we specialize. These allow us to use alternative income documentation and afford us some additional leeway on other things like credit events and DTI and such. So typically, we will not only qualify where we would not qualify, but many times we can qualify a borrower for more money or more house using these expanded guideline methods. So we're going to keep everything else the same, purchase, 30-year fixed. The only new thing here is we have an option for income verification. So when we use non-QM, we can go full doc, which would kind of defeat the purpose, right? Full doc is usually 2 years tax returns. That's what we see for conventional and FHA. So typically we're going to choose one of these other options when we go non-QM in order to use a different income calculation. So we have 1 year and 2 year alt doc. We have asset related programs we've done some shows on. Business bank statements, 12 and 24 are very popular. Our investor DSCR programs are for our investment properties. So we'll talk about those in a second. And our most popular program by far for our non-QM is going to be a personal bank statement 12-month loan. That's going to be for our self-employed borrowers because typically with 2 years of taxes, many times self-employed borrowers have different write-offs and other things that pose challenges for qualifications. So in this case, we're going to use 12 months of business bank statements to determine a debt-to-income ratio here of 40 for this borrower so that we can then qualify them using those bank statements and typically get a much higher income amount and therefore qualify them for more home. So let's check out what our non-QM rates are this morning. So it looks like about the same as yesterday. Non-QM doesn't change as drastically as the regular conventional stuff. So we have a 7.25 rate option for 1 discount point cost. Looks like the best combo the computer found for an APR of 7.297. So just keep in mind, compare apples to apples. Always compare those APRs. But we love these non-QM programs for just a little bit higher rate. It's obviously a little bit higher, but these are, again, for people who would not otherwise qualify and not be able to get the home of their dreams, and now they can. So these are great solutions for our borrowers that have specific situations. And you see there's just dozens of flavors of these programs, so please get with our team. Looks like there's one here for a little cheaper too as well. Please get with our team. We can navigate which one of these works best for you. Some of these might allow credit events and some other things. So you'll see varying costs and programs. If you do have such as a foreclosure or bankruptcy recently, there's still options for this under the non-QM program. So please get with our team. We'd be happy to navigate all of these programs for you. Now, before we go into our deep dive example, we also want to do the live rates for investment properties. So we're going to do our last 2 examples of investment properties. Same scenario, 80% loan to value, 20% down payment. Same everything else, but we're going to compare our conforming conventional products for investment properties with our non-QM expanded guidelines options. Remember, FHA, VA, USDA are not eligible for investments. So it's pretty simple. We're going to compare these 2 different options here. So we'll start with our conforming conventional, keep everything else the same, nice and simple. And let's see what our conventional investments rates are this morning. So as we say every morning, these conventional investments, they have added some additional loan level price adjustments. So unfortunately, even if we go up in rate here, there are no options for 1 discount point in cost. So the best combo the computer found with the best APR is a 7% rate for 3.5 discount points, 3.5 discount points, quite a bit. Most of our investors want to save money. So this does usually when we send these quotes, they ask what other options do we have, right? So we'll go into that next. But remember, always compare the APR. So if a customer qualifies conventional, no problem. We love to offer these quotes. But many times our investors are asking, how do I save money out of pocket? Are there any options for less discount points? And that's where, even though we can't go up in rate on conventional and get less discount points, we can go up a little bit here. It looks like 7.5, 2.875 discount points. But there's just no options with 1 discount point in cost. That's where we can come over to our final example and check out our non-QM programs. So we'll pull this up the same. We'll set it to investment property, and we'll set it to expanded guidelines, aka non-QM. Now, there's two options that pop up here. So the first option is income verification, same thing we did before. For investment properties, our most popular non-QM program by far is our investor DSCR, debt service coverage ratio. And that is because it does not require any income from our borrowers or any employment from our borrowers. We're simply going to use the estimated rental income from the property we're purchasing to determine if that estimated rental income will cover the housing expense, the PITIA of that loan, of that mortgage for that one property. So pretty simple calculation there. And it affords us the option to do many of these loans. And a lot of times our investors will have multiple properties. They can cash out multiple properties and purchase multiple properties at the same time because these loans don't rely on income or debt to income or any of these other things that are kind of moving targets. Now, the last option we have to pick is a prepayment penalty. Typically standard is 3 years. That's what we're going to price today. We can choose zero prepayment. That will limit our loan options. So I definitely do not recommend we choose that unless there's a specific reason that you or your borrower may want to use that. And same thing with 5 years. That does limit our loan options a little bit. There are options for 5-year prepay to lower our costs if our customers want to do that. So those are always out there as well. But to get the most programs and use the most common option, we're going to choose 3 years so that we can check out all our basic scenarios today. So let's check our DSCR rates this morning. And it looks like it's about the same as yesterday. So again, these don't change as drastically as the conventional stuff. So we have here, it looks like the best combo the computer found was an 8.625 rate for 8.667 APR. And that's a discount points of 0.85. So remember, before we could not find any options for less discount points. So this is an option, obviously a higher rate, obviously a higher APR. Many times our investors don't mind having a higher rate as long as the property cash flows in order to save discount points money out of pocket. So this is a great option. We love to compare side by side. For our borrowers that qualify conventional, no problem. We'd love to quote that for you. But for our borrowers that want other options, we love to provide these solutions with our DSCR programs. And you'll notice there are programs for properties that cash flow over 1. So properties that have a high cash flow can get a better deal. But we also even have options for properties that do not cash flow. There's also options for different varying prepayments. So there's just tons of different options here within this DSCR program. As you can see here, as we scroll down, that just give us a ton of different basically variations, right? So some of these may allow short-term rental income that you see with the higher rate options, but sometimes we need those programs. So please get with our team. They'll navigate which one of these works best for your situation. So now that we've gone through the live rates today, let me go ahead and switch my screen up. And we'll bring Jose in to close us out. So Jose Gonzalez, our sales manager with 27 years of experience, is going to talk about something pretty basic today, our conventional loans. So taking it back to the basics, conventional loans, obviously a great option, especially with the rates dropping today. Also FHA being kind of the comparable option with conventional. These programs are more viable today than they were even just a month ago. So a lot of great options for us to choose. So Jose is going to go through a couple deep dives here. So you ready, Jose?
Yes, sir. All right. So we're going back to basics here. Just a couple of things that I wanted to note on everybody here. Second, let me get now. We've been going through a lot of stuff, conventional DSCR, bank statements. So now we've gone full circle. And since we have had some volatility in the market, then simply wanted to, as we were saying, get back to basics and show some options here, even though you were going over some of those already. Just give me one more second here. All right. So in our first example here that we have is 5% down, conventional option. And just wanted to go over the very good rate options that we have in a little bit more detail. I know Nick was giving us the highlights with 1 point loan discount, but want to know everybody here how good their rates are getting. Right. So here in our 5% down option, this is for our excellent borrower, 800 credit score. This is in Miami-Dade County, Florida. So you see here, lowest rate option, 6.875% at a cost of $831. With our lowest rate option, 5.875. So lowest cost option, 6.875. Lowest rate option, 5.875. So we are already dipping down now into the fives, which is a very positive thing. So this is our 5% down, vanilla, cookie cutter, straight out of the box, conventional file that everybody would love to get. Now we have 10% down conventional loan. Now, want to make some show some things here a minute, is that it's not always what you think. So here 7% is the lowest cost option with a $775 lender credit, and 5.875 again lowest rate option. And I'll just show you here a minute the 5% down option. So you'll note they're very similar in price. You're talking a $50 difference at 6.875 between one option and the other. And at the 5.875, there's a difference of about $300. So not what you would typically think. Everyone assumes that LTV drops, rates going to drop significantly, and that's not really the case, because there is mortgage insurance here that is picking up the risk for the lender. So the only real benefit to drop in the LTV is obviously the borrower may feel more comfortable and can afford the lower payment. The borrower wants lower MI, or possibly they need to be at that payment in order to qualify. But it's usually not going to be any benefit in the rate. That's what I wanted to show in this example. And now we have our first-time home buyer option, which is definitely a great option for everyone to look into. This particular option is a Fannie Mae option. So there is Home Possible, there is Home Ready, Freddie Mac, Fannie Mae. They both had the same exact rates. However, as we do note in the training, there is a significant difference between Fannie Mae and Freddie Mac. There are two very important differences to consider, neither of which are rate-based. The first difference is that on the Freddie Mac loans, student loans that are in deferment are analyzed at a 0.5% of the total balance as the monthly payment, as the deferred payment amount that you input in your application. And on a Fannie Mae, it's 1%. So on a $100,000 loan, you're going to have a $500 difference in your liabilities payments. So that could affect your overall DTI and put you over the top. That's very important, but even more important, and something that came into play yesterday in one of the files that I was reviewing for disclosure with the team, is self-employed borrowers, right? So you have a self-employed borrower, you definitely want to go Freddie Mac, because Freddie Mac lets you take the ordinary income versus distributions, which means if distributions are higher, they on a Fannie file, you have to use distributions rather than ordinary income. So I throw that as an aside here, because when you are looking at the rates and you do have a self-employed borrower, make sure to pick the Freddie Mac option, right? So here you can see significantly lower rate, 6.375 is actually giving a lender credit here, and 5.5% is costing roughly 2.5 points. So very good options. Also, the mortgage insurance on the first-time home buyer, Home Possible, and Home Ready program is also reduced. The mortgage insurance factor is 0.25 versus as high as 0.43 or higher on a 5% down loan. So in this example, when I ran it, the MI on the Home Possible came up to $121 versus $152 for the MI for the regular conventional loan. So not only do we have a $30 difference in our monthly payment, but assuming costs of lender credit, let's say 6.375 here, we have 42.36 in the payment. And if we go to our conventional option, we're going to use 6.875, 43.69. So we have a difference of about $130 there in the payment of principal and interest, plus another $30 in the payment of MI. So you're looking at a roughly $160 to $170 benefit on this 3% down first-time home buyer option. And just to note, it is for first-time home buyers, which means simply a buyer who currently does not own a property now and has not owned a property in the last 3 years. So don't overlook the first-time home buyer options. And when you are out there pricing these scenarios, you do have to make sure that you select first-time home buyer and affordable as two options when you are setting up your pricing scenario so that you can get these options. So 3 good options here for conventional, 2 more traditional, and 1 the first-time home buyer, which does get overlooked every now and then. So very good option, 3% down, reduced MI, and reduced rates.
Perfect. Thank you, sir. Okay, well, we'll go ahead and wrap it up here then. We do this show at 11 a.m. Eastern every weekday, so you can see how the rates fluctuate, and we do a deep dive into a different topic every day. Now, if you are looking to get a in-depth quote for your specific scenario, you can get with one of our loan officers. Maybe they shared this video with you. They can help you out. Or if you're not speaking to one of our loan officers yet, you can contact us by going to our website, themortgagecalculator.com, or email us info@themortgagecalculator.com so we can pair you with one of our loan officers. Now, not only do our loan officers know how to do these conventional deals and go through these different options with you and are able to send you different quotes like Jose just laid out, but our loan officers are also trained in all those non-QM programs like Nick went over, the bank statement programs, the DSCR programs, all the way to fix and flip, ground up construction, commercial. So we can help you out with whatever your needs are. So appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. We will see you tomorrow at 11 a.m. Eastern. Thank you, everybody, for tuning in.
Thank you, everyone.
Thanks, everybody.